Hello, everybody. This is Sunko, the Korean bro. Today is 2023, November 15, and today we have a strong bull market ever. And even last night we had a really strong bull market. And let's see what's happening with stock market. Uh, I'm now looking at yahoofinance.com and I can see some pictures of people smiling in place where it seems like Wall Street or somewhere place. Uh, let's see what this is. Yes, okay. Stock rally lures again as target stores after earnings beats. Okay, Wall Street stocks were getting ready to rally again on Wednesday, with investors embracing the idea that abruptly cooling inflation will put interest rate hikes on ice as they waited for a consumer health check. Nasdaq futures led way higher, up around 0.6% after tech stocks on Tuesday had their best session since April. Dow Jones Industrial Average futures added over 0.3%, while benchmark S&P 500 futures were up roughly 0.4%. The jump in stocks was juiced by the surprise or easing in U.S. price pressures. Surprise easing in U.S. price pressures, which spurred back the Federal Reserve keep rates steady and could start cutting them early next year. An unexpectedly sharp drop in UK inflation helped undermine the prospect of higher for longer rates that has dented bonds. Shares in Target surged around 15% in pre-market trading after its third quarter earnings clobbered estimate. The big box retailer pointed to the resilience of the U.S. consumer in the face of higher borrowing costs. Quarterly results from a TJX companies will give more clues to spending patterns, but while the U.S. economy has held up better than expected, that hasn't translated to rises in retail sector stocks. Okay, data on US retail sales in October is due Wednesday, while an update on producer prices should cast more light on inflation. Elsewhere, consumer spending picked up in China, fresh data showed, providing a lift to an economy struggling for recovery. The country's slowdown is setting the stage for the high stakes meeting between US President Joe Biden and China counterpart Xi Jinping on Wednesday as the superpowers look to reset their fraught relationship. Okay, stocks ripped higher on Tuesday after October's inflation data bolstered investor confidence. The Federal Reserve is done raising interest rates for this cycle. The tech-heavy Nasdaq posted its best day since April, and the small-cap Russell 2000 popped more than 5%, its best single-day performance in more than a year. The interest rate-sensitive real estate sector, another 2023 laggard, popped more than 5% too, also making its best day since November 2022. With the US economy holding up, the inflation data are soft landing nirvana for the equity markets. Renaissance macro head of economics Neil Dutta wrote in a note on Tuesday. For stock market bulls, however, the action in the bond market on Tuesday might have been more significant. Treasury yields noted a cloud hanging over investor sentiment since August tumbled. The 10-year Treasury yield fell 18 basis points, its largest move since March. On Tuesday, the 10-year yield closed at 4.44%, its lowest level since September 2022. The market's telling you they expect the Fed to start easing sooner rather than later. Charles Schwab shift fixed income strategist Kathy Jones told Yahoo Finance in an interview, I will guess early 2024. The latest consumer price index released Tuesday showed prices were unchanged month over month, while core inflation rose at the slowest annual rate since September 2021. Both numbers showed inflation pressure easing faster than economists had expected. Hmm. A buy the D market is a soft landing in which inflation falls back toward the Fed's 2% target without the economy falling into recession, is what Fed Chair Jerome Powell calls central bank's primary objective. Recent data has pointed to an economy headed down that path. Tuesday's decrease in inflation follows up a jobs report that showed the labor market is growing at a slower rate. While the most recent GDP report revealed the economy grew at its fastest pace in nearly 2 years during the third quarter. And the more confidence builds among investors, the Fed is done raising rates. The more pressure eases off the pain trade that has plagued stocks for months. The treasury market certainly feels more like a buy the deep than sell the rally market now. Over a long time, there has been so much fear of rising yields and falling prices. Now I have a perception that there is a lot more people saying, where do I get in? If I didn't get 5% on my treasury, where do I go now to get it? Jones viewed that the more durable rally has broken out in bond squares with new survey data from a Bank of America out Tuesday, which showed investors are increasingly confident yields will fall in 2024. For stock market bulls like Tom Lee, head of research at Fondstrat, Tuesday's report also served as a pivot point in what has been a somewhat tentative rally in the stock market. To Lee, the key to Tuesday's report was the number of categories not seeing prices rise. Just 7 of the 31 core components in the CPI report rose compared to the prior month, a sign to Lee that inflation could be hitting a wall. This should drive a change in both Fed's view of the steepness of inflation and also the market narrative, Lee wrote. So Jones expects things could still be rocky in the fixed income markets in the months ahead. I don't think it's a smooth, glide path that Jones said. It never is, but especially in this cycle, because it's been such an old cycle. But if we continue to get decent news, if the trends continue, then yields falling is what I would expect. Hmm. Okay, let's see what this is. What's on the economy agenda as President Biden prepares to sit down with Xi Jinping? US President Joe Biden and Chinese President Xi Jinping are set to meet face to face on Wednesday for the first time in a year, capping an uneventful 12 months of up and down relations between the two largest economies in the world. The highly anticipated meeting focused on stabilizing the relationship between the two superpowers is expected to take place on the sidelines of the Asia Pacific Economic Cooperation Summit in the San Francisco Bay Area. Press Secretary Karen Jean-Pierre announced the meeting in a statement Friday morning. Members of Biden's team previewed their plans last week, saying the overall goal is for a drama-free gathering to continue to lower the temperature as well as opening new lines of communication both on economy and military fronts. We're going into meetings with realistic expectations about what we are going to achieve, a senior administration official said Tuesday, putting a damper on any expectations that any big breakthrough is in the offing. Key context will also be the status of the Chinese economy. China Beach book co-founder and CEO Leland Miller recently told Yahoo Finance that China's ongoing economic slowdown means we are in the middle of a new norm, as President Xi oversees an economy that is set to grow much more slowly than in previous years. Here are some of the top items the White House officials and outside observers expect to be on the agenda. Keeping economic and military lines of communication open. Okay, it's the first time since before COVID. Xi Jinping will visit the United States. Another key focus should be on keeping the recently busy lines of communication open after freeze in recent years. Much day-to-day communication between the U.S. and Chinese governments sees the aftermath of Pelosi's trip in 2023 Chinese spy balloon incident that has gradually been picking up. Treasury Secretary Janet Yellen has been in San Francisco for 2 days of meetings with Chinese Vice Premier He Lifens to discuss macroeconomic issues like interest rates and China's economic slowdown, with an overall focus on improving communication between both nations' economies. The United States has no desire to decouple from China, Yellen reiterated Thursday as the meetings got underway. We seek a healthy economic relationship with China that benefits both countries over time. The meetings come after months of high-level diplomatic shuffling on the economy by Yellen as well as by other officials, from Secretary of State Antony Blinken to Commerce Secretary Gina Raimondo. One key upcoming economic deadline that could be on the agenda is trade. While Biden has done little since taking office to change the Trump-era tariffs on China, his administration is in the process of reviewing some tariff exclusions that are now set to expire at the end of this year. Okay. Target clubbers muted earnings estimate, but student loans higher interest rates slow seas. Kathy Wood predicts deflation to take hold in U.S. next year. Kathy Wood said that deflation is already underway in the U.S. across industries and will force the Federal Reserve to kick off a big interest rate cutting cycle. The Federal Reserve has overdone it. We're going to see a lot more deflation going forward. The head of our investment management told Bloomberg TV Tuesday, if we're right and they've gone way too far, they'll have to cut fairly significantly. She added that the CPI inflation rate could turn negative at some point next year. U.S. inflation barely slowed in October, which markets cheered as a strong indication that the Fed is done raising interest rates. The aforementioned data was released Tuesday. Wood's prediction clashes with the consensus on Wall Street. Economists expect annual inflation to tick down to 2.7% next year from a 3.2% in October, according to Bloomberg survey. The stock market is soaring. Here's how the S&P 500 could go. The stock market is getting a jolt from the inflation report. This isn't the kind of rally that will likely peter out. Believe in this one. All three major U.S. stock indexes jumped more than 1% Tuesday morning, with the Nasdaq company 2.37%. That comes after data showed the consumer price index rose 3.2%. year over year in October, coming in slightly lower than economic expectation, and moderating from a September's 3.7% rise, with the Federal Reserve goal to bring inflation to 2%. Tuesday numbers solidify the expectation that the central bank can keep interest rates steady instead of further increase to cool the economy. The data could even mean the Fed will cut rates within the next year or so, only making stocks even more attractive. Now the S&P 500 at a ticker under 4,500 is moving above key levels. An encouraging sign earlier this year, sellers had repeatedly come in at the so-called resistance level around 4,400 to knock the index lower. They were concerned about rising interest rates and their impact on the economy. Tuesday's gains suggest those concerns are fading a bit. To be sure, the next level of resistance is around 4,500. It'll be a key to see if the index can hold the level for a while, or if sellers would turn to bring it lower again. For now, the S&P 500 is holding strong at just under 4,500. The sudden surge of buyers indicates that more gains seem likely. If the S&P 500 can stay around its current level for a few days, momentum could possibly take it above its 2023 intraday high of 4,607 in July. Okay, I get it. So strong bull is coming. Signaling more gains through the end of the year. Okay, the stock market is breaking out, signaling more gains through the end of the year. The stock market staged a technical breakout that's bullish for equity prices into year end. Stocks surged on Tuesday after the October CPI report showed inflation is cooling down. Here's where the S&P 500 goes from here after the bullish technical breakout. The stock market is in the midst of a bullish technical breakout above key resistance levels. It suggests more upside ahead. Stocks surged on Tuesday after the October CPI report showed inflation is cooling down, sparking a sharp decline in interest rates. And a 2% surge for the Nasdaq 100 and S&P 500. Technical analyst Kathy Stockton of Fairland Strategies told clients on Tuesday that the S&P 500 strong gains over the past week signal that the closely watched index should gravitate higher in the coming weeks amid a period of bullish seasonality. The S&P 500 confirmed its breakout above minor resistance from the daily cloud model yesterday. In a positive short-term technical catalyst, the breakout increases the likelihood of a test more important resistance near 4,600 between now and year end. A surge to 4,600 for the S&P 500 would suggest further gains of nearly 3% from current levels and would put the index just 5% below its record highs reached in January 2022. Meanwhile, Bank of America technical analyst Stephen Stockman said for the S&P 500 to maintain its bullish direction into year-end, the index will need to hold support at around 4,343 if any sell-off materializes. The technical bullishness isn't limited to the S&P 500. Schmidt highlighted the outperformance of the tech-heavy Nasdaq 100 suggests there could be considerable upside left in that index. Nasdaq 100 broke above its downward downtrend line from late July, holding above 15,000 keeps this upward break firmly in place, with the potential to rally back to the July peak at 15,132 and the late 2021 peaks near. So I get it. So there's way more. There's upside ahead. Even some guy from uh you know fund manager company or whatever, like hedge fund company, The guy who is good at the guy uh, who should be good at uh, technical analysis says it's now above resistance level, you know, breaking out, right? Hmm. ExxonMobil. Okay. Hmm. In spite of this year-to-date rally, the major indexes still sit well uh, below their 2021 record closing highs. Though this might be disappointing to short-term traders, there's a red carpet opportunity for long-term investors to buy stakes in great companies at a discount. Okay, let's see what they are. Okay. What's great about putting your money to work on Wall Street is that you don't need to have Bill Gates' pocketbook to generate wealth. Most online brokers doing away with minimum deposit requirements and commissions for common stock trades on major U.S. exchanges. Any amount of money, even $200, can be the perfect amount to invest. Hmm. The first phenomenal value that's hiding in plain sight, which you can add to your portfolio with $200 right now. Uh, is Alphabet. This is the parent company of widely used internet search engine, Google, and popular streaming platform YouTube. The primary reason Alphabet has backed off of its record closing high from 2 years ago is uncertainty about the US economy. Backed off of its record closing high from 2 years ago. Though the unemployment rate is historically low, a couple of money-based predictive tools signal trouble ahead. That's not particularly good news for a company that generates most of its revenue from advertising. What is great news for Alphabet is that recessions tend to be short-lived. Only 3 of 12 recessions since the end of World War II have lasted 12 months, with none surpassing 18 months. On the other hand, periods of expansion typically endure for multiple years, if not more than a decade. This means Alphabet is going to command exceptional ad pricing power more often than not. On the other hand, periods of expansion typically endure for multiple years, if not more than a decade. For decades, Google has been Alphabet's foundation. In October, Google accounted for nearly 92% of worldwide internet search. Alphabet's foundation. Google accounted for nearly 92% of worldwide internet search. In fact, Google hasn't held less than 90% monthly share of global search in over 80 years. As a clear go-to for merchants looking to target consumers, Alphabet should have no trouble steadily growing its operating cash flow from its core segment. But what's even more intriguing than Google is the company's cloud infrastructure service, Google Cloud. Despite what Wall Street perceived to be disappointing year-over-year sales growth of 22.5% in the September-ended quarter, Google Cloud has delivered 3 consecutive quarters of operation profit after multiple years of losses. With cloud spending still in its early stages, Alphabet's high growth salmon is perfectly positioned for success. The final reason to pile into Alphabet is the valuation. Shares can be purchased right now for less than 14 times for a year cash flow, which is notably lower than the 18 multiple it's averaged over the past 5 years. Okay. Hmm. Hmm. So I get that. We have a strong bull market last night and today, and it's expected to uh uh upside is expected to continue even uh at the end of this year. Hmm. And still it's going to last next year probably, considering CPI and steady interest rates and mm, all put it together. It sums up that we could have lower interest rates someday in the next year, at the first quarter or the last quarter. We never know, but things are looking great. Hmm. Okay, let's see. Now this time we have Amazon.com. Yes. Okay. 14. Okay. Amazon is a leader in two markets. Yeah, e-commerce and Amazon Web Services. They are like dominant player in two industries. And let's see how they roll. Oh, Amazon is a leader in two markets, growing in the double digits, e-commerce and cloud computing. And the company is making efforts that should help it continue dominating in both areas. In e-commerce, Amazon, already known for rapidly delivery speeds, is working to get even faster. The company has shifted its U.S. fulfillment model to a regional one from a national one, establishing A centers around the country. The shorter delivery routes means cost savings for Amazon and quicker delivery for customers, which generally prompts them to order more on Amazon. In cloud computing, Amazon is going all in on technology that could become a game changer for the business. Artificial intelligence. Amazon has increased investments in technology infrastructure to support Amazon Web Services, and has built several platforms to help business easily harness the power of AI. For example, through Amazon Bedrock, clients can access a variety of top foundation models and personalize them for their own use without having to manage infrastructure. It's also important to remember Amazon's recent move to improve its code structure not only help the company recover from last year's economic difficulties, but it should also help Amazon excel over the long term. Amazon's earnings already have started to climb again, but once the consumer and cloud clients are more confident about their budgets, earnings could truly take off. Considering all of this, Amazon looks reasonably priced at 53 times for earnings estimate, down from more than 80 a couple of years ago. Okay, so he's saying literally that current price is hella shit. Hmm. both e-commerce and cloud computing. And in e-commerce, I know that they have like a drone uh at specific places, and even they have like the system to make drone do delivery. Um, uh, they're on their path to make drone deliver medicine. Hmm. I'm not sure the process of everything, but like they are now expanding, that's for sure, and they're now growing. Hmm. Like the pace that I've never imagined, and like they're increasing their centers and states where they provide services. Okay, that's enough on this one. Ah, okay, let's see here again. Hashtashed by now and hold onto your tire. Tech behemoth Nvidia and Apple have seen their shares skyrocket over the past 5 years. Nvidia enjoys a leading position supplying its advanced chips to the burgeoning AI market. Apple's service business could eventually overtake the iPhone at its highest earnings segment. Hmm. See, as one of the biggest names in chips, Nvidia stacks an excellent way to invest in and profit from growth in multiple areas of technology. Just this morning, I read articles about Nvidia and uh, their new profit, not new profit, their new product. Um, the article that I read this morning was all about the this new product they're planning to advertise. I mean, like they don't even have to advertise because of their capacity. Because the newly made product is used for strengthening function of a supercomputer. You know, this says it all, right? I mean, chip is being used for function of a supercomputer, and this chip is made by Nvidia. This says it all because I mean, chip does pretty much everything. It's like CPU of supercomputer, right? Anyway, that core uh, is driven from Nvidia GPU. The company supplies its hardware to business across industry, powering everything from laptops to cloud platforms, custom-built PCs, video game consoles, and more. Demand for chips is rising quickly as more companies require graphic processing units like NVIDIA to take their tech to the next level. As a result, NVIDIA stock has skyrocketed 840% over the last 5 years. Alongside soaring demand for chips, Nvidia has become a favorite on Wall Street this year with its massive potential in artificial intelligence. The AI market hit a value of $137 billion last year and is projected to expand at a compound annual rate of 37% through 2030. Meanwhile, the company has snapped up about 90% of the market share in AI chips as interest in the technology has soared and GPUs have become crucial to building AI models. The company's success in the building sector led to a glowing second quarter of 2024. Nvidia's revenue climbed 101% to $13.5 billion, with operating income rising over 1,200% as AI chip sales spiked. Nvidia has hit some roadblocks over last year as rising tensions between the US and China have meant increased sanctions on the sales of high-performance chips to the East Asian country. However, the company has been quick to react rather than losing out on a major market. Nvidia has developed three new chips tailored specifically for China that can meet the rising demand for AI in the region and comply with U.S. export controls. They are smart ass, right? Although they could, their business could be affected by the way the government runs. Uh, they try to find a ways to uh, sell their customized products. Smart ass. Nvidia has enjoyed immense growth over the last year, but has shown no signs of slowing. Chip demand will likely continue rising over the long term, with Nvidia well positioned to profit significantly as it does. The stock is a solid buy for anyone looking for an investment to hold until retirement. Even he points out that you have to buy this and hold it until you retire. That says it all. I mean, like, who would recommend stock that you should have it for like over long term? It's not even long term. It's until retirement means like it's you have to hold it until death, right? Now we have Apple. Apple hasn't had it easy this year. Macroeconomic headwinds have caught up with the company, causing significant reductions in consumer spending and sales declines across all four of its product segments in fiscal 2023. Revenue fell 3% year over year after net sales tumbled 2% in its iPhone segment. The challenges have led to some pullback from investors, with Apple shares down 5% since the end of July. However, economic hurdles won't last forever, and the company's dominance in tech remains an attractive selling point over the long term. Apple holds leading market share in most of its product categories, with quickly expanding positions in digital services and AI. Despite market headwinds, Apple has actually grown its market share in smartphones this year, as consumers have continued to prefer its products. From the first quarter of 2023 to quarter third, Apple's market share grew from a 52 to 55. The company has gotten ahead by consistently outperforming its smartphone competitors. In quarter three 2023, Samsung and Alphabet sales fell 26%, 37% as total US shipments plunged 19%. However, Apple reported a more moderate decline of 11%. Okay, this is enough. Okay, see you and have a good night. And Uni? Hmm. Okay, see y'all. Bye bye.